Before we begin our investigation, a quick reminder, all information in this video is for educational purposes only and is not financial advice. While we were tracking the silver squeeze and the Pentagon contracts, the structural support of the global economy started failing. You feel rich, right? Your equity doubled in 5 years. On paper, $47 trillion in real estate wealth. But let's be real. Those trillions aren't assets. They're a liquidity trap. Welcome to January 2026. Real estate has shifted from an investment vehicle to a distressed liability. I'll show you why 2008 was just a warm-up. That was a credit quality issue. Today, it's a total liquidity freeze. The bid side of the market is gone. Subscribe to learn more. Our investigation is just getting started. Why is the market frozen? The lock-in effect. 90% of holders have mortgage rates below 4%. Current yields are 8.5%. Nobody swaps a cheap loan for expensive leverage. This is gridlock. Internal data already shows massive shadow inventory. Sellers are sitting on their hands. But this is a dam. Once prices tick down even 5%, capitulation hits, and that supply floods the market instantly. The retail crowd is hedging for a repeat of 2008, but this time the systemic risks are coming from elsewhere. First, we saw the insurance carrier exit. Giants like State Farm and Allstate have exited Florida and California. The math is simple. No insurance means no financing. Large zones are now cash only. This eliminates 70% of the buyer pool instantly. Uninsurable assets are effectively losing their market value. Second, we are seeing the short-term rental correction. The last few years saw massive retail speculation in the Airbnb sector. 1 million units were added. Revenue is now down 40%. Cash flow is negative. Now, these overleveraged investors are becoming forced sellers. And if you think this is just an Airbnb problem, look at your local bank. The contagion is spreading to commercial real estate. We are witnessing the urban doom loop. In major cities, vacancy rates are hitting 40%. Vacancy hurts local businesses. The tax base collapses, social instability rises, and asset values plummet. In 2026, $900 billion in commercial debt matures. Landlords are walking away, handing keys to lenders. Let's look at the timeline of how this shift unfolded. It started back in the first quarter of 2025, when NYCB faced challenges on commercial exposure. By the third quarter, credit card delinquencies hit all-time highs. Paying mortgages with debt was the classic signal of consumer exhaustion. Then in the fourth quarter, foreclosures spiked in the investment sector. Smart money exited early. Speculators are facing losses. And now, in January 2026, inventory is up 3 times. There is zero liquidity, and price discovery is broken to the downside. Here is the playbook on what to do. Don't catch falling knives. Real estate is highly illiquid, and exiting a position now takes 6 to 12 months. The first step is to secure your home equity line of credit. If you have a HELOC, max it out now. Park the cash elsewhere. In 2008, banks slashed limits overnight. Algorithm-driven collateral revaluation will close your access to capital. The second rule is the 120-month ratio. Don't bid unless the price-to-rent ratio is under 120. Current market is at 200. We need a 40% correction for mean reversion. And third, remember that cash is king. In an illiquid market, he who holds cash, or gold and silver, makes the market. Build a 12-month runway, not in concrete, in liquid assets. The American dream of perpetual equity growth is obsolete. We are moving to an era where mark-to-market matters more than paper gains. Check your exposure. Volatility is just starting. You are on New Era Economics. Subscribe. We will be tracking these events in real time. Thank you for watching, and I'll see you in the next video.